Ladies and gentlemen, whether you're listening from the past, the present, or the future, welcome to another episode of Pirates of Finance. We appreciate you. We thank you for your time. I'm Corey Hoffstein. That handsome man to my, oh God, I can't do that. Backwards camera. That handsome man there is Jason Buck, my beautiful and intelligent co-host, the man pulling the strings behind the scene, Captain Jack. We're excited to have you here. And I got to begin this episode with a little bit of a mea culpa. Well, a little bit of my bad. You see, one of us hosts is so dedicated to this show that we will rearrange a trip to go see their brother get married just to make time for this show. That man, I did it correctly this time. That man right there is flying in a day early and staying in a hotel an extra day so that he can record this show live this week. And yet you'll note we're not recording live. Today is actually Tuesday, April 26th, because this asshole right here forgot that he was supposed to take a trip to Scotland and told Jack and Jason last minute Sunday night and said, hey, we got to record something early. My bad. So what do? These fine gentlemen rearrange their schedule, reshuffle the deck. Monday afternoon, we record an episode. You will note that I just said this is now being recorded on Tuesday. Jason and I maybe gave the most gifted performance of our careers.
Best episode.
You were on fire. Yeah. The comments you were making were so lucid and intelligent, and it was just tight. It was a tight hour. And we get to the end and we learn that, our captain, forgot to hit record.
There's going to be a mutiny.
So now it's Tuesday, and yours truly is supposed to fly tomorrow. I am currently in Cayman Island, Grand Cayman. I need to fly through the U.S., which means I need to take a antigen test to get into the U.S. I took my antigen test this morning, and it popped positive. So here on Cayman, what that means is suddenly things go into chaos mode. I have to take a PCR test, and if it comes back positive, I'm in 7-day strict quarantine lockdown. Don't pass go, don't collect $200, which means in theory, while Jason and Jack rearrange their schedules again today for me to do this, in theory, we could be doing this live on Friday. Still waiting on the PCR test. So my bad. I'm here to bring my A game. I'm here to bring all the energy and some cross fingers that actually we could have done it live on Friday. Actually, no, I don't want it live on Friday because that means I didn't get out.
Exactly. We want you to get to Scotland. And by the way, just to double check, Jack, this is being recorded, correct? I just want to make sure.
I am. It does look. Yeah. Well, actually, I don't know. That live count.
That live. I'm not sure if that's recorded. Exactly. You can put in the comments, Jack, or you can jump on. But part of it is
what I comment is. I think so.
I think so. That's confidence inspiring. At Captain Jack, there's going to definitely be a mutiny. What I have learned, though, given today and yesterday, is now you are going to be doing all the intros from now on, because it is a exponentially better intro than mine, usually, where I just fumble through some words and throw a question at you. You've just got a real talent, we found.
Here's what I've learned about the intro, though. Here's the key. If you take the intro, and by you, I mean the generic you're in the driver's seat, which means I can ask the first question, which means you're on your heels the entire episode as I just rapid fire at you. So let's talk about, what was yesterday's episode about that is lost and will never be recovered? We talked about alternatives.
Yep.
We talked about alternatives. I suppose we could discuss alternatives again. That's the plan.
Jack liked it so much. We'll try to rehash it, but we'll bring some vivacity back to it. And
I actually have
everything we said.
I have a theory as to why Jack liked it so much. It's because he hated last Friday's episode so much that the juxtaposition for him was just like, we could have talked about anything and he would have said this is the greatest episode ever, because he hated our discussion about NFTs with a violent passion.
Yeah, it turns out Jack hates crypto. And so I hope everybody at Blockworks realizes that just Jack hates crypto. So just want to put that out there into the ether. Jack, I hate crypto Farley. So as he's lighting up our chat screen here. So alternatives. I think, Corey, we started talking about yesterday.
What are alternatives? What does it even
let's start
mean?
with definitionally, right? Like ideally, at the basic level, people see the world as just stocks and bonds, and everything outside of stocks and bonds is considered alternatives, which makes no sense to you or I, but let's just start with that definition. Stocks and bonds are your traditional asset classes, and then anything outside of that is alternatives. So, I mean, that can mean even like private equity, venture capital, or even private credit is considered an alternative. I think you disagree, that you think that some sort of distressed or private credit or private equity is technically more traditional these days, or what do you think it is?
Well, I would disagree that it should be alternative. Just because you take something and you move to a less liquid form, should it be alternative? I would argue no. Is it alternative? I think you're right. I think most people categorize it as alternative. Equities and bonds, probably anything that's like a liquid bond. So in this day and age, you're talking about government bonds, investment grade corporates, high yield bonds. All of those are probably considered for the most part fairly traditional. As you get into weirder bond sectors, maybe less so. I don't know if people would really consider emerging market bonds, for example, non-alternative. I don't think they would. I think they would consider those alternatives based upon the advisors that I work with. But I think the idea is like your core cheap risk premia that every investor knows that they should be long and strong. Global equities and global developed bonds and investment grade bonds are probably the core assets. And then everything else just gets lumped in this other bucket that has this title alternatives.
Well, yeah, what I think it speaks to is that 60/40 is so ingrained with people that that's what they think is a traditional investment. Anything outside of 60/40, as we talk to a lot of financial advisors, RIAs, is like those are the alternatives, right? It boils down to 60/40, and then everything else is alternative. So that's kind of the rubric we're working under. But I was, every year in late January, we have all our alternatives hedge funds conferences in Miami. And they're Miami, all the way from West Palm all the way down to Miami, and they always tend to fall in the last few weeks of January. And so what I found there is like alternatives is a lot of things. It was been interesting is like pre-pandemic, it was a lot of like, private credit, post-pandemic was a lot of vol space, a lot of, everybody's interested in vol all of a sudden. And the last one is just this past January, it was crypto managers were getting the most meetings, it seemed like, at the Fontainebleau. But then part of it, I told you, one of my favorite stories though, and thinking like, is this private credit or not? And the other thing is like you and I talked about is like, all right, you just said, is private equity, VC, or even distressed private credit, is that alternative, right? When it's just a leverage version, right? Like PE is just a leverage version of regular equity. VC is an ultra leverage version.
Right. It's just equity. You're just buying equity.
Right.
Just because the company's private or public, or you're using leverage or not, it's equity. It's just a different stage of a company, right?
Yeah, but you get that sweet mark to model.
Yeah, you do. You get that lagged vol.
What do you think vol was last quarter? I think it was probably single digits. It sounds good.
Well, it's just because the prices didn't move quarter over quarter, so zero vol.
Exactly, zero vol. And so one of the first times I went to Miami for the alternative hedge fund week, I was in the lobby of the Fontainebleau, and I've told you this story before, but it reminds me of thinking about what are the alternative forms of private credit. And Floyd Mayweather was walking through the lobby, and I think Floyd's down there every January. He's always doing stuff in Miami. He loves the Fontainebleau, but he's walking through the lobby with just a huge entourage, just tons of beautiful women, as Floyd's always with, and enormous bodyguards. And walk past Floyd, and not only 5 seconds later, perpendicularly walking by me is Howard Marks, just by himself, no assistant, anything, just eating an apple. I'm like, "What's up, Howard?" He's like, "Hey, how's it going?" And that juxtaposition in that lobby of the Fontainebleau was just fascinating to me. And that's why, for those that don't know, Howard Marks runs one of the biggest private credit funds in the world. Some would call it distressed investing. Some would call it vulture investing. People will disagree. But once again, he was speaking at the alternative hedge fund week. And that's what originally made me think about, like, wow, they really do count alternatives as anything that's non-60/40.
Yeah, I think that's right. One of the things that I find fascinating is how much this 60/40 concept is stuck into the finance community. I actually had a tweet, I don't know, it was a couple of weeks ago, where I said, I think it's really telling, and I didn't say what it was telling of, but I think it's really telling that the entire finance community has gravitated towards the 60/40, and yet no one actually knows where the concept of a 60/40 came from. Now, I like to do tweets like this where I say it's telling, but I don't say what it's telling of, because then I get both sides who presume I'm taking the opposite side of them, just yelling at me in the comments. Once again, it becomes complete goblin town down there, which is a little fun for me every once in a while to invite the violence. But everyone was so certain that they knew the true history of a 60/40. Oh, it comes from modern portfolio theory and Markowitz. Oh, it comes from this paper related to how pension funds were managed in the 1950s. It comes from the global market portfolio when the original papers were written. It comes out of optimizations. Honestly, as far as I can tell, and I have it on good authority, some very senior, well-known researchers have tried to find the answer. Nobody seems to know where the answer came from. No one knows where a 60/40 portfolio came from. It seems to have organically emerged, which I find interesting in a whole other way from like an evolutionary perspective. Perhaps that makes it more robust than we give it credit for. Like it wasn't just some answer in a paper that everyone went to for marketing reasons. It's actually maybe a surprisingly robust answer over time. You and I can discuss maybe the flaws of a 60/40 at some point, but look, it's interesting, right? And again, that is what is accepted. That's what clients can tolerate. That's what investors can tolerate. Deviations from that are tracking error. Anything that creates tracking error, therefore, must be an alternative.
Yeah. For a second there, I thought you were going to pull a global macro manager on me or global macro newsletter writer and say, I have a secrets high up inside the Fed or the government, and here's what they told me that where 60/40 came from.
Okay, but I need to ask you a question, because this is where things get like weird and nuanced for me. If I were to tell you I have a 60/40 and my equity were invested in value managers, is that alternative?
Alternative to classic 60/40 or an alternative investment?
Do I have alternative exposure?
I would actually argue, this is a great question. Actually, I haven't thought about it that way. I would argue that factors are now traditional.
Okay, so let's do it. Now let's do it a different way. I have a 60/40 and I hire a portable alpha manager who I give them some of my equity as collateral, and they implement a long short value strategy on top. Is that alternative?
Okay, here's the way I'll think about it, and I'm going to answer it in a tangential way, because I was thinking about what is traditional and what's alternative, right? And I would boil it down to like what's easy to buy, and quite frankly, it's become what is the government has mandated easy to buy, right? If I have listed equities and listed bonds, and especially in ETF form, and especially target date funds for retirements, it's super easy for people to buy and hit that buy button, whether they're financial advisors or people doing it for themselves, or it's part of their 401k. And, shout out to Mike Green for all the work he's done on that passive. But I don't think, Mike's work's phenomenal. But I think anybody that had looked at like their parents or their friends' 401k and saw they had no choices. Like I think my dad has like 6 choices because he's older and it was kind of grandfathered in. And then even though he's a grandfather, that's funny. And then but like younger people in their target date, they just have one line item. They can't even choose. It's like Vanguard or BlackRock, like target date funds. And so once again, through legislation, these are the things that are liquid, easy to buy, allegedly, right? Just hitting the buy button. So I'm bringing that back of like, to me, that's why it may be traditional, is that's the 60/40 is the super easy to buy, when a lot of stuff we're talking about are illiquid alts that are private funds and not so easy to just hit the buy button. You might have to take another step. So that's why in this framework I'm using, to me, any sort of factor investing or any sort of long short, if you're using publicly traded equities, I would consider that traditional.
Yeah, the reason I bring it up, right, is because I think a lot of people put long short, and I hear them do this. They put long short into their alternative bucket, and I don't know if that's wrong, because I think a lot about long short is a client perception issue, which we can talk about in a minute. But the reason I brought up that, like, hey, I've got global equities that are value tilted versus I have passive global equities and I hire a long short manager to overlay on top of that, is because those can actually be mathematically equivalent. That when you take a tilt within your long only portfolio, it is mathematically equivalent to just buying the market and then going extra long those names you want more of and implicitly short those names you want less. And when you net those out, you end up with a factor tilt in a long only portfolio. So, and yet people would say probably the first is not alternative, and yet the second is alternative. And I find that interesting. I point out I want to go back to what I said, which is I point out people use long, short in the alternative bucket because I think there's a client perception issue with the financial advisors that I work with. I think, again, it goes back to alternatives is sort of a communication to the clients of almost don't try to understand this. Like, this is just going to zig and zag randomly. And when the market's up, this could be down. Hopefully zero correlation is what they're looking for. And that alternative label, I think, maybe is as much communication as it is like thoughtful allocation, right?
No, that's fair. Although I laughed when you said long short because the P&L looked the same as just like delevered long equity, and I couldn't help myself there. But like going back, so that's what we're talking about in stages, right? Like you have stocks and bonds. Anything outside of that's alternative, and then we started talking about levered stocks or bonds. You have your PE, your VC, your private credit, vulture, distressed, etc. And then going into the world we inhabit a lot of is the next large bucket is typically CTAs. And what does that mean? Commodity trading advisor. But a lot of times people think CTAs as just trend followers. But there's a lot of different strategies that you can do in managed futures. But like that's the hard part is, once again, they have a terrible naming convention. They've been done a bad job of naming themselves all these years. They're either called CTAs, managed futures. Sometimes they try to go for alternative hedge funds. At one point, they called themselves crisis alpha strategies after 2008. We'll get into whether that was good or bad. But the idea is when you trade managed futures, you open yourself up to a broad swath of asset classes you can actually trade within the future space. You can actually trade global stocks and global bonds using like market indices around the world. But the more important part is like the commodity side. And you have commodities and you have FX. You also can trade rates as well. And then on the commodity side, you have, energies, metals, softs. You can get up to, 80 to 120 markets, depending on the different, geographic locales you want to trade. And now they've got even alternatives. You can trade even the Chinese markets at this point. But the idea is, if you're in managed futures or you're technically a CTA, which is just the legal definition, you have a lot of alternative strategies that you can trade. And then to talk about the bulk or the majority of them that are trend followers, they're basically going long and short all of these different markets, right? And they're looking typically for a breakout strategy is the way to think about it, where most strategies are mean reversionary or convergent. They're kind of like waiting for markets to mean revert and come back into line. And your typical CTA trend follower is waiting for a divergent strategy. So they're going to buy high, looking to sell even higher, and they're going to sell low, looking to buy even lower. So they're literally trying to take advantage of those trends, both long and short, which makes it typically, just by the strategy's definition, uncorrelated to like equity, buy and hold equity markets. So that's why it's usually a good alternative. And anytime people run like an efficient frontier, you'll see a lot of times they say, ideally you should allocate, upwards of 40-50% into CTA trend followers, just because of the diversification it gives you. I was actually thinking back to your 60-40 when you said it is, it reminded me of Markowitz. Didn't after Markowitz came up with efficient frontiers and modern portfolio theory, and people then ask him what he did with his own money, he goes, 50-50 stocks bonds.
Yeah. He wanted to minimize regret. I think that quote came out in the 2010s. Well, let me ask you this. Do you consider CTAs alternative?
Well,
like, not to you, do people, do you personally?
No, I don't. To me, they're not alternatives. And actually, we'll get into what I think are alternatives. Like, to me, no, these are massive asset classes that can handle tens of billions of dollars. So to me, they're not alternatives. When I think about alt, I think about a lot of like crazy illiquid strategies. We'll get into definitions of what those are. But to me, it's just another, and just like I said with 60-40, where you can hit the buy and sell button, you could do the same thing with futures.
Part of me wonders, the reason I ask you whether you think of CTAs as alternative is, as you were talking about CTAs, I allocate heavily to them, and I don't really consider them to be alternative. I consider them probably in a bucket I would call hedge fund beta for the most part, where I think maybe there's some alpha there and some manager selection. I don't think I can choose those managers, so I tend to do an ensemble, and I think it's just hedge fund beta. But I wonder how much of that is me just being comfortable, right? I understand equity factors. I understand alternative risk premia. I understand CTAs. And so I don't really think of those things as being alternative. If you were to say, hey, Corey, I have a business where we own and lease airline engines, maybe I would start to say that's alternative. I would put here's something I do consider alternative: gold. Because I have no idea why gold should move. People say it's tied to real rates. Other people say it's just supply and demand. I don't know. And so I guess again, I sort of default back to like alternatives are I don't know bucket. And honestly, I don't allocate to things I don't know. So I personally don't own any gold other than through CTAs. But maybe like I'm finding myself using that framework, even though I'm sort of publicly dismissing that framework as being a little silly.
Yeah, I just laugh when you talk about gold. I think about like I've been trying to study or figure out what gold is for 20 years. I still have no clue. I'm on like the Dunning-Kruger trough there. I still don't know what gold is, but also hold gold like personally through CTAs, through our funds, etc. Because yeah, I still don't know what it is, but like we have that history. But like part of that history, as you and I know, is like it allegedly gold has maintained its purchase power parity for over 2,000 years. And yes, that's true, but it like depends on that. That's a very long time frame. And, people say, well, it's been the same cost, for purchasing power with a medieval knight's, armor to now a bespoke suit on Savile Row. And it's like, yeah, but like in an intervening year or decade, it might not track your purchase power parity at all. So it's like over a long enough time horizon. Yes, maybe, but I'm just throwing that out there.
So again, do you think gold is alternative?
No, because you said familiarity, and so I'm gonna dive into that a little bit. I don't think I've ever run this past you, but like I've kind of had this theory, and I hate when people break up the world into two types of people. But so I was thinking about it's like two types of people, right? When we're starting to learn about finance, you either come up in the Warren Buffett tradition of like that value investing and learn everything from Warren Buffett when you're a teenager, you read all his books, or to me, you that come up with market wizards and you're reading about CTAs growing up. And so I come from the camp of more reading from CTAs, so that's part of it. But I also thought about a third one recently. And I'm curious where you're going to find yourself. The third one is Greenblatt's "You Too Can Be a Stock Market Genius," which is special situation investing, because that's a whole different camp that we saw with like the Big Short guys.
Yeah, Greenblatt's reminded me a lot of Buffett, actually. So I would sort of.
Well, he's a value guy anyway.
He's a value guy. I was actually thinking it was Greenblatt who wrote the little book that can beat the market, right?
Yeah, but he also wrote You Too Can Be a Stock Market Genius.
Yeah, I don't think I read You Too Can Be a Stock Market Genius. It's funny you were mentioning Graham and Buffett in one camp and Market Wizards in the other. I read both of them when I started.
Of course you did.
I think just very much confused myself.
Of course, Corey Hoffstein's like who put himself in any sort of camp. I read them all at the same time. I read it.
It didn't help. It didn't help. I just confused myself. That's all.
So so like you said, it's interesting. Like when you ask me personally, it's familiarity, because I also traded futures for decades now, and that's more what I came up was starting my first trading account was in futures. Probably because, as people like to make fun of crypto or YOLO traders and meme stocks, is because of that implicit leverage you can get in futures, which cuts both ways. You can either use it prudently to hedge, or you can be a teenager and use it to try to YOLO trade as I did in my teenage years. So maybe that's just it's a familiarity issue. So let's keep like kind of moving down or keep going along the lines of our taxonomy here. The other one that's like very private, but actually the largest asset class in the world is both commercial real estate and residential real estate. So in both of our worlds, that's considered alternatives, even though that's the thing that people are actually most familiar with at a retail level. And it's also the largest asset class in the world. But then as soon as we start getting into real estate, you can then start breaking that down. Like, okay, there's a big difference between German rental real estate, office leasing in New York City, and trailer parks in like the Southwest of the United States. So you have, once again, you have a taxonomy underneath that of different forms of real estate. And then you can even go into farmland real estate, whether you're growing, organic berries in California, or you're growing, pulses in the Midwest, or, avocados in New Zealand. You have that full gamut as well. And timberland falls into that too, where a lot of endowments used to love timberland, but kind of moved away from that. So that's kind of like the other, and that like that asset class is bigger than the traditional one. So like now I'll flip it back on you. Do you think real estate is a traditional or an alternative asset class?
All right, I've come up with a unifying theory. I'm going to blow your mind.
Oh, great. All right.
So do I think that most people I deal with treat real estate as an alternative asset? When I see it in most advisors' allocation models, they typically have a carve out for real assets. Real assets are a subset of alternatives, and REITs end up there. Every once in a while, REITs end up in the equity bucket, which is probably more correct. I mean, REITs are considered an equity sector if you look at sector composition.
They trade liquidity like an equity, yeah.
It's probably more correct, but I tend to see very frequently there's like a real assets component of the alternatives bucket, and it falls in there. All right, here's my unifying theory. It's all about cash flow. If an asset has cash flow, then it is a traditional asset, right? It's very easy to map out why it should be priced the way it is. If it doesn't have cash flow, whether that be something like art or watches or systematic trading strategies, it's alternative. Now, as I'm saying that, though, I think about something like art, and I go, well, I could, in theory, purchase an art piece and then lease it to a gallery and make cash flow. So is it not alternative?
Yeah, but
I don't know. I'm blowing my own
cheating
mind
there, right? But also, I think you're right though in the sense that, and this may be why people think about managed futures, CTAs as alternatives, because like there's zero return unless you overlay a straight trading strategy on it. They're non-cash flow investments unless you go out and trade like the publicly traded equities, once again, in like gold miners or wheat farmers or whatever you want to attach to that commodity. But just trading the raw commodities, like you said, they don't have cash flow. And a lot of people think they're just zero return investments with a lot of volatility. And so then you need a trading strategy that can harness that volatility. So that one's pretty good. I don't mind that one. But like I want to get into maybe what I consider alts, being in the space and having like trading a lot of asset classes, which we do internally. And so when I think about alts, it's like the real alts. That's where we start getting out in the kind of really unique spaces. The most basic one that's kind of normalized is small to mid market credit. So like just lending to SMBs. That's one we see often. Another one's royalties with like music and video games. Life settlements. Maybe some people are familiar with that or not, but basically you're taking over people's life insurance policy, and we can get into the ramifications of that. Litigation financing got really big in the last few years, where you're helping finance, a tort lawsuit, or now people have even gotten a lot of money's flown into that. So now people are even financing just law firms and giving them credit facilities. Another one, one of my favorite too, is like a friend of mine's just trying to start a Stallion Fund where, you're using, prize horses to breed, hundreds of times a year. And what you're getting paid for that, for each breeding section, I'm choosing my words very carefully, is an interesting income stream. The other is like cell towers, mobile infrastructure. Those are an interesting one too. That's been fascinating. Go ahead. Sorry.
So I don't want to cut you off, but I find it interesting. Everyone you've mentioned so far has a cash flow stream associated with it, and there's a operating business for the most part.
Yes, but to me, these are like the true alts, because it's things we don't hear about necessarily in the mainstream, but also they're usually highly capacity constrained and very granular. So like I was going back to, like, you can't just hit a buy and sell button. Like it could take you months to tranche into these investments, and you might not be able to get out for 7 to 10 years.
So there's a liquidity aspect there, and I do think illiquid stuff ends up in the alts bucket. But I think that's wrong. Like alts should not just be catch-all. You should have an understanding of your liquidity needs and make sure that if you need liquidity, it's in liquid assets, and then the rest can be illiquid if that's the bet you want to make. Again, I don't think the liquidity aspect of something makes it alternative. If I invest in a company as a startup, or before it goes public or after it goes public, I'm buying equity all the way down most of the time. Why is public equity considered non-alternative, but my seed stage investments are alternative just because they're illiquid?
Yeah, well, once again, I don't think you and I are actually coming up with an answer. We're end up even more.
I'm telling you, my grand unifying theory: cash flow.
Yeah,
it's cash flow.
Okay, so you're saying these are traditional, but now if we go to any financial advisor, they're not going to have these in their book. But I did come up with some more since yesterday that I want to run by you.
Hold on. Are we saying financial advisors are ultimately the ones that get to dictate what is alternative?
I think that's the way that the vast majority of, especially Americans, think about their investing portfolios.
Okay,
is through a financial advisor.
Right? You're 100% right. Yes. If we were to ask financial advisors, are those alternatives? Yes, particularly because to get into them with their clients, they're going to need high net worth clients. They're going to have to do lots of extra paperwork. They're going to have compliance issues with whatever firm they're at. That's alternative for sure.
And you need specialized due diligence and all those things that a lot of times they don't have in-house, which is why it's hard to do these things. And some of the new ones I thought since yesterday, by the way, were marinas. Carbon credits are getting popular.
Lots. I tried to buy a parking lot once. No joke. There's a parking lot near a beach that my business partner and I used to go every summer to go charter a fishing boat as sort of a company trip. And we would drive by this parking lot and go, we need to buy this parking lot. And we tried.
You should have. My deal that got away is I used to be a commercial real estate developer, as you know, and I was trying to roll up all of the city's parking garages into one deal. And man, if I would, that one haunts me. So
I was sitting. I'm just going to go on to tangent town here. I was sitting in a presentation once, and it was a REIT, non-traded REIT out of Atlanta, and their specialty was finding smaller commercial buildings. And then what they would do is they'd roll up all the positions into a portfolio and then sell that portfolio to large endowments, because the large endowments like Harvard can't spend all the time doing that many deals. They need a large book all at once to deploy their capital. So the edge was basically being willing to go out and buy all those small properties, bundle them up into a package, and then they'd have endowments bidding on the package. And that's where the premium came from. I was like, that is alpha. If people are sometimes it's like, what does alpha look like? That is alpha. That's alpha from blood, sweat, and tears. But you just found alpha in the market. And it's not from a mispricing necessarily. Well, actually, it is a mispricing. It's that the endowments want this exposure and you can upcharge them for it.
Well, it's a couple of things. And we're always bundling and unbundling. Like back in the day, what I would do is you could buy a building of 20 apartments, and you're basing them on that rental cash flow and that cap rate. But then if you already know that you can go out and legally separate those into individual entities and sell them as condos, and the parts are worth more than the whole in this sense, instead of the reverse of what you did, that's where you can make money, is bundling and unbundling. So that's been around forever. It's like you're selling upstream, but also a lot of people don't know is like, if you aggregate enough real estate too, you could turn it into that REIT, like you were saying, and REITs are going to inevitably have a lower cap rate. So you can almost double your money overnight from going from private to public. But what you're actually referencing, I think is fascinating, is actually it's the cost of capital. Because those larger real money are such huge players and they can't come downstream enough, they're also willing to pay more because they're closer to the sources of capital. So they have a lower cost of capital, so they can make a better yield.
I have a funny story for you.
Yeah.
So the week before my wedding, I got an email from a gentleman from Norges Bank. I wasn't really paying attention. I knew that they were in town. They were doing sort of a road show from New York up to Boston, which is where I was before going back to Norway. Now, I didn't look up Norges Bank. I was like, this is like a Bank of America equivalent, like just some guy going on a road show. And he asked if he can come in, and he was coming in right after my wedding. And I said, absolutely. I'm pretty much more than happy to meet with anyone when they're in town. I love meeting people. And I said, I just want you to know I don't have time to prep for this meeting because I'm getting married and then I'm going on my honeymoon, and this will be the day I come back from my honeymoon. So like, if you need me to prep anything, I apologize. I really can't, but happy to have a discussion and we can take it from there. He says, no, just want to come through. Been reading your research. Would love to sit down. So he comes in and sits down and he starts explaining who Norges Bank is. Well, Norges Bank is Norway's pension. Right? It's their sovereign wealth fund. One of the largest sovereign wealth funds in the world. Right? And if you don't know the story, basically Norway survives off of oil and fisheries. And so to create another sort of like pseudo GDP element, they took all the money they were making and started making investments. And so they now have this massive sovereign wealth fund that serves as like this diversified third leg of the stool for their economy in many ways. Why am I talking about this? Well, one, it was embarrassing when I'm sitting there realizing who they are. That was really not a great look for me. But two, the reason I bring it up here is because they were at that time making the decision that they wanted to get into real estate around the globe. And he was saying for them to make a dent in their portfolio, the first thing they had to do was hire 1,000 people so they could scour the entire globe for real estate deals, because they had to deploy so much capital that's how many people they needed. And it was just talking about operating on a different scale. And you realize how difficult it is to deploy that much money.
And the third thing you realized is that their minimum allocation size was larger than your capacity. So this meeting.
Oh, they made it very clear. They were just interested in talking. There was zero chance of us ever getting an allocation.
Speaking of which, by the way, like that, I was listening to I think it was Invest Like the Best, or what's Patrick O'Shag's podcast. I think he was
Best like the best.
Yeah, he had Baliasny on, and he was talking about their internal tech team. They're taking up from 100 to 200 people, and it's just like for their pod
That's
shop.
a big fun to fund, right?
A pod shop. It's
Pod
all
shop.
internal. They have 120 teams, but like it's just thinking about those numbers versus like what you and I do. It's always hard to wrap our heads around. I want to get back because I have a couple of things that might be contradictory to some of your unifying theories so far, or some of the other things you've said. And one is gold yields. So you can actually lend out your gold to jewelers and make cash flow off your gold. So how would that? You said if it cash flows,
lend
traditional.
your gold to jewelers. I don't say how you get that back.
Yeah, it's over like cycles. Yeah, it's not easy to get back if shit hits the fan. But it's a very common thing that people do is they lend out their gold to jewelers, and then you have like Franco Nevada where you
Just
can get
be clear,
royalties.
it's not like I give a gold bar and expect to get the same gold bar back. It's I give a gold bar and I expect to get a gold bar back.
Bar back.
Fungibly
Yes,
treating this. Okay. So it's
Correct.
You're lending. It's the same way of lending money. It's just a different type of lending money.
Right. But you were saying gold doesn't have a cash flow, where I'm using a pseudo cash flow.
Yeah,
overlay.
I will also which I get, and again, it goes back to me like with the art. You can create a cash flow from many of these assets. All right, it's like in a weird way, it's sort of like I'm sure you can rent clothing and watches and jewelry to people as well. Like you can create cash flow out of a lot of assets. So yeah, maybe anything can be an asset. I still think if it doesn't create cash flow itself intrinsically, I'm calling it alternative.
All right. And I was talking to a fund the other day, and shout out to Cordillera that does really interesting alts, which I'm considering alts in this bucket. And this is going to be your favorite one that I don't know if you've heard of before, but they do spirits lending. So they basically do inventory financing or factoring on whiskeys that are in barrel.
Really?
Yeah.
Okay, that's very.
I know
cool.
that one's got you. That one's got your wheels turning and everything. I'm gonna keep talking because I know where I'm gonna lose you for about the next 5 minutes. But that's one of their favorite avenues right now is lending to whiskey distillers and figuring out, providing that sort of lending and financing as they are waiting for those to age in barrel over time. Is that cash flow?
Okay, but I mean, I guess lending is cash flow, right? Like.
Yeah.
I don't know.
But I think that's where you used to.
So take it another direction though, like the people who buy exotic whiskey as an asset, like, right? And they've done incredibly
collectible
well.
too.
Collectibles,
those
right?
are collectibles,
So let's talk
which
like
is
collectibles, like watches.
Doesn't gold fall under
cars.
collectibles?
I don't know. Is gold I mean, I think you would insult a lot of people if I called gold a collectible.
No, technically, because because it makes me think about DAOs these days. The way DAOs are getting away from being a security is a lot of them are investing in collectibles. That's why you had Constitution DAO, because it's technically a collectible.
If you
and I think
talk
gold
about
falls
crypto,
under collectibles.
Jack is going to stop recording.
Well, that's actually where I'm headed next, because you talked about fake cash flows. So let's get into crypto. Crypto is an alternative, but our DeFi deals, are they cash flows? So is that traditional?
Before we talk about that, can we talk about Sam Bankman-Fried on
of course
the Odd Lots podcast? So
yeah,
I don't want to make assumptions about what people know. And so Sam Bankman-Fried is the founder of Alameda Research, which is a crypto hedge fund that is enormous, as well as the FTX exchange, which is, at least last I checked, the third largest exchange, though probably rapidly climbing on the second and first. And he is a unique cat, seems to be very thoughtful, and a great advocate for the space most of the time. And he went on Odd Lots and just had the strangest dialogue where he tried to explain DeFi yield farming and literally just explained it as a Ponzi. And they called him out on it. And he was like, yeah, it's a Ponzi and we make a lot of money from it. And it was just like the most shocking thing I've ever heard from a guy who is like trying to get crypto through the regulatory machine. Like that episode doesn't seem to be doing him any favors.
Yeah, I mean, everybody should go listen to it because it's interesting. He basically describes it as a magic box that people think has value because they give some of the money in that magic box back to them, and then that they think that's yield, and so it just grows in value over time as more and more people think the magic box is an ATM machine that spits out yields. And like you said, Matt Levine was on it as well, but Matt was even like, I wouldn't even describe it that pessimistically, and everybody thinks I'm a pessimist.
Yeah, Matt was like, I'm the most cynical person, and that was even cynical for me. So yeah, it was telling. Okay, so is crypto alternative? Well, interestingly enough, from a correlation perspective, it seems to be more and more, just long crypto seems to be more and more correlated with equities, NASDAQ tech stocks in particular. Yield farming, on the other hand, I would say is most of it is Ponzi's. So in which case it's a scam, like, are scams alternative? I don't think we want to invest in them anyway. I guess knowing it's a Ponzi, I don't know. This is a weird one. This is a mind bender. But the other
Well,
ones, there is some cash flow element to it, right? Like if I am putting my coin pair in an automated market making pool and I am providing liquidity, I will earn a percentage of the money flowing through that pool as a fee. That is cash flow. And to me, that is a I would say, I mean, yeah, crypto's weird, but it's a non-alternative because there's a very defined cash flow associated with the position.
would you carve out CeFi lending as just traditional private credit? And that's almost outside of the crypto bucket in a way.
What am I lending? Like
Crypto, but like to like trading for like you're lending Bitcoin or other, maybe, well, yeah, maybe if you get outside of Bitcoin and you're lending it to like SIG or Jump Trading or whoever to trade with, and then you're really doing credit analysis on the individual traders that you're lending to.
Yeah, I don't know if that's any different than, say, long and lend that happens with institutions, right? If you are
Right.
a large endowment and you own, all you want to own is the Russell 2000, there are market makers who will pay you 50 to 70 bips a year to be able to borrow that whenever they need it. So if I say I want to be long crypto and I want to then put it at some centralized exchange to be able to lend it out, I don't know if that's any different than long and lend that happens in traditional markets.
Speaking of which,
And to me, that's a thing about asset utilization, right? Like if you want to maximize the return of what you have, well, yeah, if you think the counterparty that's going to borrow from you is trustworthy and you trust their credit, then that's a great way to make a little extra yield. Unfortunately, for most individuals, they can't do it. It's hard to securities lend as an individual, but in crypto, you can.
Speaking when you just said about lending out and everything, it reminded me of our mutual friend Med Faber talks a lot about ETF structures, and that if people actually use short lending on the ETF structure, you could potentially have an ETF that instead of charging, low fees, actually paid the clients based on the lending. Do you think that's even viable, or is that just kind of a
So I'm going to be
hopeful
really arrogant here, and I think I clued Meb into that. I've been talking about that for years because it's something we did in our fund. So the securities lending space is actually incredibly crowded when you talk about individual securities. Firms like BlackRock
right?
are lending out the stocks that they hold for people who want to short to earn the fee, right? That short borrowing fee, and they're passing it back to their clients. They're earning some of the fee, and by law, they have to pass it back to some of their clients. Vanguard's doing it. BlackRock's doing it. When you talk about the S&P 500, there is very, very little juice that's left there. But when you talk about ETFs themselves are not lent out very much because the people who own ETFs tend to be retail individuals in retail brokerage accounts that don't have the ability to lend. And what you find is there are certain ETFs like the iShares High Yield Bond ETF, HYG, that is actually very in demand from people who want to short high yield bonds as a hedge. It's the most liquid ETF out there. For whatever reason, people decide they don't want access to CDS or whatever. They want to be able to short high yield bonds, and they go short that ETF. And because there's not enough people lending it out, you can make 70, 80, 90 basis points annualized for lending that ETF out. And so I actually joked. I said, I should create an ETF called like HYG Plus, HYGP, that all it does is it holds HYG and lends it out. And I could charge 20 bips for that product, never manage a thing. It would be completely automated. And as long as I lent out HYG, I could completely cover my cost for the most part and outperform HYG.
That's kind of you mean you gave a really unique scenario there with HYG, a very specific scenario. But in general, are you going to make enough off of lending to over hurdle like a 70 to 90 bip management fee? Like,
yeah, so
is that realistic?
Meb, over at Cambria is it's like I think he overstates it for individual stocks. There's certain subsectors, and again, it's episodic. It depends on what the market needs, and it's all about supply and demand. When you talk about a portfolio of individual stocks, it's tight in the mega cap space. In the small cap space, it gets better, but in the mega cap space, I don't think you can really make up your fee for the most part. But he also has ETFs of ETFs. So I know that there are some of the ETFs that he owns within his own ETF that he could lend out. And maybe he doesn't make 80, 90 basis points like HYG, but certainly 10, 15, 20. And that's not getting netted out of the fee, the expense ratios. It shows up on something like Morningstar, but it is a return that's being given back to the investors. And so I do think there is a case that you could actually, if you were to put all that together and you were to structure your portfolio correctly, you could actually probably have a negative fee ETF after securities lending. And it gets better than that. I mean, I know at Simplify, they have an ETF that holds a basket of high yield bond ETFs and then does a long short overlay on top. And I talk to them, include them into the fact that they should look into securities lending because one of the ETFs they held was HYG. And they actually found that they could one-up securities lending by going to a bank and doing a total return swap. And I believe they get paid north of 150 basis points in that total return swap. So they get HYG plus 150 basis points.
But then they make it so you can cash sweep daily. I was just going to say you're taking credit risk with the person providing the
and you are taking credit risk, right? For sure. And look, sec lending, there is credit risk there as well. Now, normally there's an offset. You're working with an intermediary many times, and that's why you're earning a fee. That's where the credit risk is. But you could do it with multiple banks, hopefully, and limit that credit risk. But yeah, I think we often overlook many ways in which there are to utilize our assets to earn extra fees because we have to go through these extra hurdles. Setting up sec lending is not always easy. Individuals probably can't even do it. As funds, it's not always easy to set up. The first time I set it up in a fund, I think it took 9 to 12 months to get all the plumbing in place.
Yeah, that's why when I started was I thought traditional stuff like stock bonds, target date funds, or that's traditional because it's so easy to buy, right? Where if you want to do sec lending or anything else, like we were talking about alternatives, you might have to do a lot more legwork and a lot more homework, and it might be harder to do. And there's granularity issues, and there's credit risk issues. There's all those sorts of things. And then while we're talking about alternatives, I'm curious. And by the way, if you haven't answered this, tell me off the show. Please don't put this on the show. Is that thing about float and Buffett's float? I'm always trying to find unique forms of float. Buffett talked about insurance float. At that one point, was it called blue stamps or whatever that blue book they had? Now you have Costco or Amazon Prime is an amazing form of float. There's got to be forms of float out there that we're not thinking about that are tangential alternative forms of float. Like I said, if you have a great answer, just don't say it on the show.
No, I wish I had a great answer. I wish I did.
Yeah, it's interesting.
Let me put it this way: if I had a great answer, I wouldn't be a host of the show. I would be a multi-billionaire sitting on my yacht somewhere.
So then, then now we know when you Kaiser Sose on this show that Corey found his float.
That's right. I found my float. I want to make one last point about the sec lending, not to belabor it. After all that said, I want to point out I don't do sec lending anymore in one of my funds because what happened is I had to change custodians because the custodian I was using was bought by another custodian. That custodian has their own internal sec lending desk, and the costs that they applied for sec lending were going to outweigh the benefits that I could loan out anything that I had in my portfolio. So it doesn't always make sense to do sec lending because often there are fixed costs whether you run your own desk or you outsource it. So you have to be careful with some of that stuff, but certainly I think the ETF space, it's an untapped potential for a lot of people. And it goes overlooked because it looks ugly to be a fund that holds ETFs because it jacks up your expense ratio.
Yeah. Another one that may throw off your theory of everything. One entire subject that we haven't covered yet is options in option space and whether options is an asset class or not. But the secondary one is systematically selling volatility for cash flow. Is that a traditional or alternative?
All right. Hold on. Okay. Well, one at a time. All right. Well, look, you got me all flustered. Let's calm down. Let's talk about futures for a second.
Okay.
If I take a fully cash collateralized S&P E-mini futures exposure,
Mm-hmm.
is that not more or less the same asset as just buying cash equities? Like, would you,
Absolutely.
is
But
that an
even if you use a
alternative
levered
asset?
version, it's the same to me.
Okay.
But
So if I buy a super deep in the money call option, is that different?
leverage equity. Yeah.
Right. Well, yeah. I mean, and then, but if I buy a super deep out of the money call option, how, like, it's
Leverage
got a very
equity.
different payoff
Yeah.
profile, right?
You have to deal with your Greeks, but people are thinking about the delta exposure as leverage equity.
Right. There is that volatility component to it for sure. And I guess that's another question of like path versus payoff, right? There's a premium you're paying for the leverage based on the implied vol, and you could just argue the amount you're paying for the leverage is high or low, so long as you're holding it to expiration. If you sell it before expiration, then your profit and loss is going to be heavily dictated by that implied volatility. So then it becomes, if you're trading it and you're not holding it to expiration, are you actually tapping into a different exposure, which is implied volatility as an asset? Yeah, that one bends my brain. Is that alternative?
Yes.
I don't know. I don't know.
Finally got there. I have finally got there.
I don't know, man.
To bend your brain status.
52 minutes in, you got me.
Yeah. Speaking of which, let's bring in Captain Jack, because you and I have a long history of alternatives. So maybe Captain Jack will have some different questions for us that doesn't have as much exposure as we do. So maybe it'll be interesting to see his
And
thoughts.
we cannot forget we are introducing a new part of this show, which is
Yeah.
Chart Crime of the Week.
Oh, did you actually bring one today?
No, I was going to say I forgot. So we're
we'll do that next
introducing it, but we're not doing it.
Yes.
Wow, you're pre-pitching it. I love it.
Listen, I want to get people excited to tune in for the next one.
Didn't we have some other segment ideas? I can't remember what they are anymore.
I think you had a brilliant one.
We were going to talk about our long shorts of the week, but then we came up with a third one
yeah.
too last time.
No, I like that, long and short of the week.
I got none because we had to do this on such short notice. My short of the week is Corey Hoffstein. I'm short Corey Hoffstein.
Okay,
Really?
So,
I'm short Corey
That's
Hoffstein,
fair.
but I'm not as short. I feel like you should be more short me than you are short Corey.
Well,
That's
yeah,
fair.
both you are my shorts, but at the same time, Corey's my long because I hope he gets to go to Scotland.
I deserve
me
that.
too.
I deserve that. Okay, my long and my short are going to be the same. Are you ready? I got super long F1 after watching that Netflix show everyone told me to watch. Man, that was great. And then I went and I looked up people's feedback about the show, and I learned all about like the manufactured drama.
Oh, who cares?
And they were saying like these people aren't really like this, and the Netflix creators would spend weeks and weeks recording people, and none of that got on. And all of a sudden, a lot of these drivers don't want to take part anymore because they feel like they're being misrepresented just for the TV drama. So I'm like newly long F1, but now I'm feeling like more short this show.
Okay, but at the same time, you're saying that reality shows that shoot hundreds of hours of footage are unbelievably edited to create drama. That's shocking, Corey. Really shocking.
That is shocking to me. I can't believe people would lie on the internet.
Well, like it's like there's like the three sides of the story. So like they're editing, it happens and they choose which they edit. And yeah, like you've had like Max Verstappen saying he doesn't want to be a part of it and stuff like that. But also at the same time, everybody in that space has had a cascade effect because they added like 75 million new like fans. The Liberty Media that owns F1 went from like 8 billion to 13 billion. That's cascading through the drivers. So now after season 5 or 4 or 5, like you can get upset about it, but like you were, that trough is awfully
benefited.
rich.
They all benefit.
Yeah.
The other sort of like mind-blowing thing for me was recognizing how young these guys were.
Yes.
And how long they've been doing it. And like they all start. It's not like you're like, I tried it in college and it turns out I was really good. It's like, no, we have been racing together since we were babies. Right? We were racing with Hot Wheels basically, and then we just all like go into karting, and like it is crazy to me what it takes to compete at these ultra high levels now. That if I were like Wonder if my kid would be interested in becoming an Indy F1, an F1 driver. Well, better put him in a car at age 2,
So, Jack, what was your any hot takes or anything that you thought was interesting that we talked about that you hadn't heard of before? Or?
Yeah, I think my long would probably be the return of a negative stock bond correlation, but I'd say with Corey,
spoken like a macro guy.
It's a little quanty.
And by the way, Jack, you're also cheating. The idea of the long short was outside of finance.
Oh
yeah, but we didn't tell him that. I don't think we told him that.
Yeah.
I could have told from context. Yeah, for sure. But Corey, I think you're a really smart guy, Corey.
Are you going to short me right now? Are you really going to short me?
Oh man, he's buttering you up for the downfall. He's about to knife you in the back.
A really smart guy. But I think your definition of an alternative is something that doesn't generate cash flow runs into a lot of hurdles for me. And I'll just give one. Like, what about a Chinese electric vehicle company that's like never made $1? Like, that doesn't have a cash flow. Doesn't have revenue. Yeah.
It's not whether it's currently making cash flow. It's whether it's like in theory, a cash flow generating business or cash flow generating asset. Like, in theory, you're buying the equity because it should one day have cash flow. If you don't think that business ever has cash flow, then it violates every financial fundamental law for it to have a positive price.
Okay, then you don't think private equity is an alternative, right?
No.
But you think commodities are an alternative?
Yeah, I think commodities probably would be an alternative for me.
Can I say another way, Corey? I think I've run this by you before, and I don't think you were a big fan of it, and I haven't fully thought it through yet. But like, to your point about cash flow,
these are my favorite questions.
Yes, as I give a long preamble as I want to do, is the idea that like you can only make money off of equity or debt, and then everything else that we use alternatives for is to hedge the left tails of equity and debt, and that's proper portfolio construction. But everything breaks down to either equity or debt as far as long GDP ways to make money.
Maybe, Jason, it's really risk-free.
Don't get so close to the mic. Don't do that.
Hold on. I gotta really think about this one. Risk-free rate, as Jack edits the levels. The risk-free rate, call options and put options. Maybe that's really mind blown. The true assets, right? Equity is a call option on the residual value assets of a business. Debt, right? You're selling a put option.
Yeah, but to me, that's what you either this time or last time you were saying too. That's why you don't think options are their own asset class, because once again, it breaks down to equity and debt.
Yeah, but I'm saying you can explain equity and debt with options.
Right. Or that's what I'm saying. They're different sides of the same coin.
They're sort of like fundamental building blocks, not an asset class. Like, they're just a structure. They're a payoff structure. So I don't know, Jack. I mean, look, I'm mostly full of shit 99% of the time, and I just say it really confidently. So,
well, that's because, as you referenced earlier, you're a masshole.
Yes. I was born and raised this way. It's not my fault.
And so, Corey, you draw a line between something that makes money or has a natural cash flow, like a business, or whether it's owned publicly or privately, or a bond, which gives you cash flow, versus a synthetic cash flow, like owning gold, or not even owning gold and lending it, like Jason was talking about, but owning GLD and then selling a put on it, or selling a covered call on GLD.
Yeah, I would look at something like that as a synthetic cash flow that you're generating, and so it would be alternative. I would look at something like even CTAs. While they're not alternative to me, I think actually should be classified as alternative because they're sort of synthetically creating a payoff profile that's not intrinsic to the assets.
And so
again, I just want to point out, I have completely fabricated this line in the sand that this is a hill I will now die on, but I completely made it up in this episode.
I'm actually going to take the other side of Jack Short, because I think you might have actually stumbled onto something. We haven't fleshed it out yet, but I can guarantee the comments are going to flesh it out for us and tell us what kind of idiot you are.
Yeah, whatever. They will not be kind to me. That's for sure.
No. But I think you might be onto something. I got to think. My initial reaction is like, I like the cut of his jib on that one. That one's interesting. We'll have to flesh it out. Jack, you were going to say.
Well, I think it's Corey has part of it. It's the cash flow, I think. But then I think it's mainly the liquidity thing, which is an ease of access. So, for example, it's easy for people to buy a stock. It's easy for them to buy Apple. It's easy for them to buy a real estate investment trust. But to buy an actual home, it's a huge pain in the ass. So, office real estate, even much harder. Kentucky bourbon whiskey as an investment, extremely hard. So the harder you distressed debt, like you can't do that.
All
you
right,
can't
Jack,
just do that.
I think you're onto something, but I want to take this from a different angle. Maybe alternative is something that most people don't own, right? So I don't think most people would consider housing alternative, because the vast majority of people have or aspire to own a house, at least in the U.S., right?
It's common, yeah.
It's common. Most people commonly own equities. They commonly own bonds. Do they commonly own racing horses? No.
That's very alternative.
So maybe alternative, maybe I'm completely full of shit. Maybe alternative is really just not commonly held by most people.
That goes back to your familiarity argument. Like, just because my kinks are different to yours, they're not alternatives. It's just what I'm familiar with.
So if you grew up in Kentucky on a horse farm and you owned a ton of racehorses,
Nice.
STY would be alternative to you, but
I was asked what I thought a definition of alternatives was on an interview yesterday, and my response to it was, it's sort of like pornography. You just sort of know it when you see it.
I'm pretty sure that interview was yesterday's interview that I forgot to record.
No. I did then say it on that.
Okay.
I had an interview at noon. That's where it came from. Because I was like, honestly, I don't know. You sort of know it when you see it, but it's really hard to define exactly what it is.
Yeah. I mean, like, private credit, that's alternative. Distressed debt, that's alternative. High yield bonds, less alternative, but more alternative than investment grade, which I guess is more alternative.
I think used to be alternative, right? In the 1980s, high yield bonds would have been considered a fairly alternative investment. And now they've been packaged up and financialized in an easy to access ETF. Commodities pre-1995, there was no index. Goldman created an index. It was an alternative investment, and then it was financialized, and now it's easy to access. Would people consider it an alternative? I don't know.
Right. In the fixed income universe, I think people would also, investors like Howard Marks also deal with things like bank loans, sometimes called leverage loans as well. But here's the thing. You know who else deals in bank loans? Banks. So if you own like JP Morgan, they have a bunch of alternative investments on their thing. Like likewise, if you buy, a farming company, they have a bunch of, if you buy a gold miner, they have a bunch of gold. If you buy Freeport McMoran, they have some gold and a lot of copper.
Or as Corey, you're saying, they used to be called alternatives, used to be leverage buyouts, and now they're private equity. We just rename them and they become more familiar. Right. I think we should end it there, because we also don't have enough time to maybe get into what's traditional or a cash flow of a rebalancing premium coming from return stacking asset classes. So maybe we'll get into return stacking next time.
We'll save it for next time.
Stacking. Yeah. All right, cool.
Jack, hit him up. Yeah.
Thanks, everyone.
Oh, we need to, by the way, like, subscribe, share with all your friends.
Let me hit the thing. 1 second. Give me a second.
Let me find the button. In the meantime,
where's the button?
One. That guy up there, this is like Brady Bunch. That guy up there is Jason Buck. Follow him at Jason Mutiny on Twitter. The guy trying to figure out the production, Jack Farley at Jack Farley 96. This guy right here, Corey Hoffstein. Follow me at C Hoffstein on Twitter. Don't forget to like, subscribe, comment. I'll read it. It'll make me angry. You'll enjoy that.
Yeah. Leave your comments. Don't